Hey guys, welcome back to my channel. If you are new here, I talk about algorithmic trading, backtested trading strategies, Python, AI, and personal finance. Today I am going to show you one of the very good strategy that I backtested on Bank Nifty. So it has been profitable consistently every year starting from 2011 to 2024. Okay, let's get into it. So this is the agenda that we are going to cover. So first we will look at the strategy and then few examples to understand the strategy. Then we look at the backtest results of that strategy and then finally my take on the strategy. So let's get into strategy. So it trades on Nifty Bank, but you have to use either futures or options or ETF to trade it. And the strategy type is intraday. So it can be both long and short, and it trades on 5-minute time frame. So these are the indicators that we are going to use: Bollinger Bands, Keltner channel, typical price, average true range, which is nothing but ATR. The typical price, the formula is given here, but this indicator you will get on the trading terminal or trading view. Before we look into the buy rules, let's set up the indicators. So I am using the Kotak Neo platform, but you can use any platform which offers trading view charts. So Bank Nifty, 5 minutes. So let me add the first indicator, which is Bollinger Bands. Second is Keltner channel. Third is typical price. Fourth one is ATR. So we need one more ATR. So I am going to click one more time. So I have added all the indicators now. So let me change the settings quickly. So for Bollinger Bands, I am going to hide the median, which we don't need. Length is 20, multiplication is 2.5. For Keltner channel, 80, multiplication is 2. And we don't need the middle band. To avoid the confusion, let me change the color of Bollinger Bands. So the upper band I am giving red, lower band I am giving red. So now the red bands are Bollinger Bands and blue are Keltner channels. And let me change this ATR settings. So this length is 40, this length is 500. So the rule is simple: whenever the candle closes above Bollinger Bands and Keltner channel, then that becomes our buy signal. So in this case, this candle is our buy signal. If any new candle closes again above these bands, then that becomes a new buy signal. So we will have to update our entry price based on this new candle. So the entry price is calculated using this formula: typical price plus 2 times of ATR. Here length 40 to account for the momentum of these candles. Once entry is triggered, then we can place stop loss with this formula: entry price minus 2 times ATR. But here length 500. The reason is to place stop loss based on the volatility of last few days, not just the recent candles. If stop loss is not hit, then we are going to exit the trade at 350. So now we are done with the indicator setup. Let's look at one of the example. And the close price is 51690 and Bollinger Band upper band is 660 and Keltner channel upper band is 553. So in this candle, the buy signal is generated and the ATR is 92.26 at this candle of the 40 length. So we are calculating entry price with typical price plus 2 times ATR, which will give us 51,858.75. So once we know the entry price, we place the entry price here. Our signal is generated over here, and somewhere here the entry is triggered. Then we can place our stop loss order. For stop loss order, we are going to use this formula: entry price minus 2 times ATR. The 2 times ATR here is 500 length at this candle. So we are getting 51705. So the stop loss we should place at 51705. But in this trade, the stop loss did not trigger. So we exit our trade at 315. Since we bought at 51858 and exited at 52343, we made a profit of 484 points, which is 7,200 rupees. Similarly, For sell rules, the candle has to close below both bands of Bollinger Band and Keltner channel. The entry trigger price is calculated instead of plus, now we have minus because we want to sell when price falls. So it is again calculated using typical price minus 2 times ATR. Once entry is triggered, we will place the buy stop loss order with entry price plus 2 times of ATR. If stop loss is not triggered, we will exit at 315. So if we look at example again, so this close is lower than both the lower bands, and then we calculate entry price based on typical price, which is 51351 plus 2 times of ATR, which is 63.58. So in this case we got our entry price as 51224. So we place our entry price over here, which is 51224. Once that get triggered at this candle, we place our stop loss order, which is above this price, which is a buy order. So we calculate using this formula. We place it at 51365. Since we did not hit our stop loss, it is coming down, and then at the end of the day at 315 we exited our trade. So in this trade we made a profit of around 6300. So some consideration before you go ahead and then do back testing. So you are allowed to do only max 3 trades in a day, and you should not take any entry before 9:20 and after 3 p.m. So you should not be using any candle from the previous day for the entry signal. If you are already in trade, then you should not take any additional trades. So before we go into the backtest results, let's see one of the example in the chart. So I am going to show this example. This happened on 29th October. So this candle closed above this. If you cannot see it clearly, then you can look at prices over here. That way you can confirm. Here the close price is 51610, which is higher than Bollinger Band of 51600. So it is closed higher than this. Since this candle is closing higher than these bands, let's calculate the entry price. So I have created an Excel to calculate that. So the typical price for this candle is 51567.02, and at this price level the ATR 40 is 90.38. That gives us entry price of 51747.8. So for this buy signal, this will be our entry price. But before we reach entry price, we have another candle which closed above these bands. So we will have to update our entry price. So here typical price is 51673.17 and ATR is 91.33. So our entry price is 51855.85. So now once our price reaches at this level, our entry will be triggered. So at around 12:55, we have our entry triggered. So now once entry is triggered, we can place the stop loss order by using this entry price as the calculation. So this 51855 and ATR at this candle for 500 length is 79.7. So now we have our stop loss as 51696.45. So after our entry triggered here, the price did not come down and we close our trade at 315. Similarly, we can see the sell example. Here you can see this candle closed below both the bands. So the typical price here is 51352.07 and ATR is 63.47. So that gives us entry price at 51225.15. And this has been triggered at 9:30, and then after that did not go back, so we did not hit our buy stop loss, and then at 3:15 we are exiting at 800.85. So now we understand the strategy. Let's look at the backtest results. So this is the equity curve. So overall it has generated 31% average yearly returns, very minimal drawdown of 15.3%. So the drawdown is basically once you reach a new height on equity curve, how much it has fallen. So in this case from 0 it has fallen up to 16%. So it will decide whether we will stick to strategy or not. And we should not look at drawdown alone or returns alone. We should look at returns by drawdown ratio, which is 2.06. If returns are 100%, drawdown is 75%, then we cannot trade that strategy just by looking at returns. If it is more than 1, then it is a good strategy. That means we are generating more returns than the drawdown. So in this backtest, I have considered the slippages, the brokerage with 20 rupees per order, which is standard across different brokers. And I have considered all charges, including STT, GST, SEBI charges, other charges. So for these results, I have used 1.5 lakhs as a margin for trading one lot. So this is the distribution of the returns year on year. It is profitable every year. So on a year like 2020, where there are good directional moves, the returns are very high. And on a year like 2017 and 18, where the market did not move much on intraday time frame, so the returns are lower. But if you look at on monthly basis, there are some months where we don't make profit. So you should be ready for this when trading this strategy. At certain point of time, you have 4 losing months continuously. So you should not stop trading this strategy just because you have 4 losing months. But there are certain instances where you have continuously 9 months of winning. So it is all part of systematic trading. These are some more metrics of the backtest. The drawdown days are 387 and Sharpe ratio is close to 2 if you know the meaning of it, and R square of the equity curve is 0.96, which is close to 1, generally above 0.9. It is considered as good strategy. And if we look at detailed trade metrics, winning days are only 42%, but on winning days we are making 1.6%, but on losing days we are losing 0.8%. So that makes the risk reward ratio of 2. So we should always look in combinations of win rate and risk reward ratio, not in a standalone basis. And this is one more important thing. So the winning streak is 7. So continuously on 7 days we made profit. On 11 days we continuously lose money because this is a trend following strategy. This is a typical behavior of that. And coming to months, so we are profitable on almost 70% of the months. On an average, we are making 2.6%. So this is Monte Carlo simulation of the backtest. So it will tell us when to stop trading a strategy, because from the backtest we got a drawdown of 15%, and from Monte Carlo simulation, so we have a 95% chance that this will not exceed 37% drawdown. But if it exceeds 37% in live trading, then we should stop trading this strategy. So I put together one comparison to show the effect of slippages and charges. Without slippages and charges, the returns are 44%, but once adding slippages and charges, that made it 31%. So that is why you should always consider the backtest by considering the slippages and charges. So if you don't know what is slippage, it is nothing but if you want to buy at 100 rupees, but you could only buy at 101, that means 1 rupee is your slippage. So that makes it 1%. Finally, you should test this strategy before you take any live trades based on this. And also you should remember that you will not make money with single strategy in market. So you should basically trade pool of strategies, so that if one strategy is in drawdown, another strategy will not be in drawdown if they are uncorrelated. For example, equity and gold are uncorrelated instruments. Similarly, you should create pool of strategies which are uncorrelated. So as always, markets can be unpredictable. So risk management should be your top priority. Let's summarize this. So this is the equity curve, which looks almost linear and going upwards year on year, and written by drawdown ratio of 2, and more than 2 is excellent, and win rate is only 42%, but that should not decide the strategy. Risk reward is 2, so when you win you make 2, when you lose 1. Now, since you cannot trade this strategy on Nifty Bank directly, once you get signal in index, you can trade in futures, or you can buy ATM option, or you can sell ATM option. So if you are not comfortable with 15% drawdown, these are the 3 ways you can reduce the drawdown. First, you can increase the capital size. This is considering 1.5 lakh per lot. If you trade with 3 lakhs per lot, then this makes it 7% and this makes it 15%. And if you are happy with 7% drawdown and 15% return, then you should increase the capital size per lot. And you can also combine option strategies with hedging to reduce the risk, where your margin also will go down and risk will also go down. And you have to trade multiple strategies. Then if this strategy goes down, then another strategy will make for it. Then you will not see the impact of this drawdown. So that's all for today's video. So if you like this video, hit the subscribe button and let me know in the comments if you have any questions.